Welcome to this analysis focused on big picture earnings. Today we're unpacking the recently released financial results for UiPath, that's NYSE Path, for its third quarter of fiscal 2026.
And we're going to get right into their forward guidance, too. The numbers themselves, well, they tell a story of a pretty definitive beat.
Right.
But the real takeaway here is how they're pulling off this massive pivot towards what they're calling agentic automation.
Okay, let's unpack that financial story first, starting with Q3 FY 2026, which closed out on October 31st. UiPath posted some really strong results that topped market expectations.
Oh, absolutely. When you look at the top line, revenue came in at over $411 million.
Wow.
Yeah, that's a solid win. It just blew past the consensus analyst estimate, which was what, closer to $392 million. Hitting that top line beat is, it's critical for investor confidence.
And it wasn't just revenue, right?
Yep.
Profitability also beat expectations.
It did. Non-GAAP earnings per share came in at 16 cents, which was just a penny ahead of the 15-cent estimate.
But more importantly, that $411 million in revenue, that's a 16% increase from the same quarter last year. That's pretty significant growth.
That 16% growth is the foundation, sure, but what's really interesting is the context from the CEO, Daniel Dines. He didn't just celebrate the numbers. No, he tied it directly to the momentum they're seeing in scaling this new phase of intelligence.
Is agentic automation. Okay, for listeners who might be more familiar with traditional RPA, robotic process automation, what exactly is agentic automation? Why is it such a big deal for a company like UiPath?
That's a great question, and it's a crucial distinction. Think of it this way. Traditional RPA is like a robot that follows a very rigid script. It's deterministic.
You tell it what to do, it does it.
Exactly. Agentic automation is more like hiring a genuinely smart, goal-driven employee. An agent is autonomous. It can see a goal, it can assess the situation, plan its own steps, and even course correct to get there.
So instead of being told, click this button and this button, it's told, resolve this customer issue, and it figures out how.
Precisely. It's a fundamental shift from simple task automation to, genuine process orchestration that's powered by these really sophisticated AI models.
And the earnings seem to show that companies are buying into that vision.
They are. I mean, look at the core recurring metrics. The Annualized Renewal Run-rate, or ARR, hit $1.782 billion at the end of the quarter. That's up 11% year over year.
Okay, 11% ARR growth, 16% revenue growth. Is 11% ARR growth enough, though, given all the hype around agentic AI? Does that feel a little slow?
That's a fair point. Some might expect it to be higher, but you have to look at where that growth is coming from. They added $59 million in net new ARR this quarter. But the real insight for me is the dollar-based net retention rate. It's sitting at 107%.
Break that down for us. What does 107% actually mean?
It means that if you take all the money from your customers from last year, that same group of customers is spending 7% more this year. And that's after you account for anyone who left.
So they're not just staying, they're expanding.
Exactly. They're expanding their use of the platform. In a space this competitive, that kind of loyalty is a massive strategic asset. It proves the platform is sticky.
Which gives them that predictable revenue while they make this big strategic shift.
Correct. And that shift is expensive, which brings us to profitability.
Right. And this is where the financial side gets really interesting. The CFO, Ashim Gupta, he highlighted a huge milestone, saying they achieved their first GAAP profitable third quarter.
And if you look at the GAAP net income number, it's staggering. They reported almost $199 million in GAAP net income for the quarter.
And what was it last year?
Last year, same quarter. A net loss of about $10.6 million.
Wait, from a $10 million loss to a nearly $200 million profit.
Yeah.
You don't get there just by selling more stuff. What's behind that huge swing?
Well, that's where you have to be a critical analyst. A jump of that size, it almost always reflects accounting events. Things like stock-based compensation, maybe equity grants. It's not usually a sudden, miraculous operational change.
So the headline number is great, but the real health is in the non-GAAP numbers and the cash flow.
That's where I'd focus. And their operational efficiency is definitely shining through there. GAAP operating income was $13 million, a 3% margin. But the non-GAAP operating income, which, strips out those big non-cash items.
It's a real story.
That's the real story. It soared to $88 million. That's a 21% non-GAAP operating margin.
21%.
Yeah.
That's just some serious leverage and efficiency.
It does, and it's backed up by fantastic gross margins, 83% GAAP, 85% non-GAAP. Their cost of revenue is really well controlled.
And cash.
Cash is king. Both net cash flow from operations and their non-GAAP free cash flow were positive, around $28 million for the quarter.
Plus, they're sitting on a massive pile of cash, right? Over $1.5 billion in cash and equivalents. What does that let them do?
It gives them immense flexibility. They can fund R&D aggressively. They can go after strategic acquisitions, all without taking on debt. And you see that discipline in their spending. Sales and marketing expenses actually went down a little bit year over year.
That's interesting. Growing revenue by 16% while spending less on sales and marketing? How does that work?
It tells you their sales model is maturing. They're getting that growth from existing customers expanding, that 107% retention we talked about, and from their partner ecosystem. They're not just hiring more salespeople.
Okay, so let's pivot from the financial what to the strategic why. The CEO, Dines, he stressed that customers want a unified platform, not a bunch of separate tools. And they got that big recognition from Time magazine as one of the best inventions of 2025.
This is the core of their strategy. They know they can't build every single AI model themselves. So their goal is to be the indispensable central orchestrator for all of it. They're not trying to compete with the giants, they're trying to integrate with them.
Okay, so let's talk about those integrations. The biggest name has to be Microsoft.
The Microsoft integration is probably the most critical one for enterprise customers. They've integrated with the Microsoft Azure AI Foundry, and they're using something called a Model Context Protocol to link up with Microsoft 365 Copilot.
What does that mean in plain English?
It means their orchestration tool, Maestro, can manage workflows that use both UiPath's agents and Microsoft's Copilot agents all in one place. It gives you a single point of control over these really complex multi-AI deployments.
So UiPath becomes the conductor, making sure all the different AI instruments are playing in sync.
That's a perfect analogy. And it explains their other collaborations too, like with OpenAI. They're building a ChatGPT connector to pull those powerful models into specific governed enterprise workflows.
And what about the Google partnership?
That one's about accessibility. They launched the UiPath conversational agent, which uses Google's Gemini models for voice interaction. So you can basically just talk to it to start an automation, no complex coding needed.
And then there's NVIDIA. That one feels different, more about security and performance.
It is. This is for high-trust scenarios. Think fraud detection in banking or patient management in healthcare.
Right, places where you can't afford a mistake.
Exactly. When there's real financial or legal risk, you need absolute confidence. So they're using NVIDIA's Nematron models and NIM to build really fortified, high-performance AI into their workflows. It's about making AI reliable enough for the most sensitive jobs.
And finally, Snowflake, connecting data to action.
Yeah, that one's about closing the loop. The partnership with Snowflake Cortex AI lets a business turn an insight from their data like spotting an anomaly into an immediate autonomous action orchestrated by UiPath. It connects the brain to the hands.
That ecosystem approach seems to be getting a lot of validation from third parties.
It is. They were named a leader and a star performer by the Everest group. That star performer tag is a big deal. It shows they're moving fast and adapting.
And Gartner recognized them beyond just simple RPA.
Right. A leader in the Magic Quadrant for Intelligent Document Processing, IDP, and for AI-augmented software testing. It shows the platform is really embedding intelligence across the whole tech stack.
But as you deploy these highly autonomous AI agents, governance and security become, well, everything. What are they doing to make enterprises feel safe?
Governance is probably their key differentiator. They achieved ISO 42001 certification. Now, for the listener, this is huge. It's the world's first international standard specifically for managing AI systems.
And why is a standard like that so important for adoption?
Because for regulated industries, it gives them a framework to manage risk. It's an external validation that says, we have processes to deploy this responsibly. It helps CIOs and compliance officers sleep at night.
They're also helping to write the rules too, right?
Yes, they're a founding contributor to something called AIUC1, which is a security framework for AI agent adoption. And on a practical level, they launched their automation cloud in the UAE to meet strict local data residency laws. It's a full-court press on trust.
Okay, so a clear financial beat, a strong strategic engine. What's the forecast for the final quarter of the year?
The outlook is confident. They're projecting Q4 revenue between $462 and $467 million. That range sits right on top of the analyst consensus, which shows they're comfortable with their momentum.
And recurring revenue is expected to keep climbing.
Yeah, they see ARR growing to between 1.844 and 1.849 billion by the end of January. So, continuous customer expansion.
And a big jump in profitability is expected, too.
A huge jump. They're forecasting non-GAAP operating income around 140 million for Q4. But, and this is important, they were very cautious about forward-looking GAAP results.
Right, because of that volatility we talked about earlier.
Exactly. Management was very clear that things like stock-based compensation expense are just too unpredictable to forecast accurately for a GAAP reconciliation. It just reminds us that non-GAAP is the better yardstick for their operating performance right now.
Looking at the stock, it closed recently around 1486. It's had a strong run in the last 3 months, up almost 30%, but it's been pretty flat over the past year.
And that stock performance really tells the story of this pivot in real time. The recent jump suggests the market is starting to reward the execution and the strategy. The flat performance over the year reflects the cost and the uncertainty of making such a big transition.
So to sum it all up, Q3 was a definitive beat on the top and bottom lines, backed by solid ARR and great operating leverage. They're positioning themselves as the critical orchestrator for Agentic AI through deep integrations with basically every major player, while building a moat around governance and trust.
So I guess the final thought to leave you with is this. Given UiPath's aggressive push to be that central orchestrator and their serious commitment to standards like ISO 42001, how quickly do you think big companies will actually shift their most critical, sensitive workflows entirely over to these AI-governed platforms? The presence of that certified governance might just speed up that timeline faster than a lot of people think.
Thank you for joining us for this analysis of the sources.